and we'll kind of go over what's happening in the markets. Well, this is the Monday morning mortgage message. This is the bond market. Now, I've talked a lot about what the bond market is doing, and this last couple weeks has been, I mean, as you can see, this roller coaster down. Today we pierced down below this, so the mortgage bonds are having a bad month. Let's just say that. We thought we had a good run here. Inflation numbers came in lower, and then just the economy is so strong that the bond markets are just getting hit every day. And then we had a jobs number that came out that was showing signs that the economy was slowing a little bit, but then we had inflation come out and it was a lot different than expected. It was hotter than expected. We thought it was going to come down a little bit more than it did. And so this last week, we just got hammered. And then today we started out low as well on the bond market. So this is kind of scary to see. These are the average rates for 20% down. And this is not my rate monitor, by the way. This is for the industry. 20% down on a 500 with a 760 credit score. These are the average rates right now, guys. So what can we do to overcome this? And what's happening? Like, what's going to happen next with the bond market, with mortgage rates, with the economy, with housing? A lot of people are on the fence. They don't know what's going to happen because it's so uncertain. The Feds, we believe, are going to raise another quarter, but they may pause. It'd be beneficial for us if they had a more of a posture of, we don't need to do anything. We've done enough. We think inflation is going to come down. If they say something like that, then we could see a rebound here. On Wednesday, they're going to release the Fed minutes, which is basically what their notes on what they're thinking. So that's going to be really influential this Wednesday. But as far as what's happening next, I want to go over what I believe. And these are the main factors of what is going to happen next. Like, are we going to see rates continue higher, or are they going to come down? So the main reason why rates are currently going up is because inflation is continuing. The Feds are trying to slow down inflation, and they're trying to do so by raising short-term interest rates. It's an overnight rate, the Fed funds rate, and they've been doing it a lot, right? Almost every month, except for they took a pause for the last almost year. And there really hasn't been a massive impact. Inflation has come down, but it's kind of stalemated right now. We're kind of at a standoff. So we really need those inflation numbers to continue to come down. Strong employment numbers are going to keep mortgage rates higher. Again, we don't want strong employment numbers. The Fed really wants, they really, really want to increase the unemployment numbers. That's their goal. Their goal is to increase unemployment, slow down the economy. The Feds have been somewhat pessimistic in the last, what they've been saying as far as inflation, and that's the verbal cues that they're giving in their meetings. And we also have $2 trillion in treasuries. Remember, treasuries are bonds. We have $2 trillion that the government's going to try to sell, and that's going to be hitting the market in the fourth quarter. That's the whole Build Back Better, the CHIP, the infrastructure bill. All of those, they need to raise funds for that. The government doesn't have money. So they have to raise the funds for that. So what do they do? They sell off bonds to people like you and I, and to investors across the world, to raise capital. So we can invest in those bonds and make 4 to 5%. And that's what they're trying. That's what they're hoping we'll do. They're hoping we'll invest in those. We'll give them our cash, and they'll use that cash to do what they need to do with the infrastructure bill and the CHIP bill. But that exacerbates the whole issue with flooding the market with bonds is not a good thing, because if not a lot of people want to buy them, they'll lose value and then rates will go up. So that's what I'm a little worried about for the fourth quarter this year. So what do we need for mortgage rates to drop? We need inflation to fall. We need inflation to drop. We need it to go down quickly. Now, I think this next month is going to be rough. September inflation numbers, I think, will stay about the same or maybe come in a little hotter, which is not a good thing. And I think that's going to push the Feds to raise the Fed funds rate again this September. Fingers crossed that we'll get some really good unemployment numbers. So if we have unemployment, meaning good for us, not good for the employees, right? But we want unemployment to go up. So in the next couple of weeks, about a week before the Feds do their next meeting, we're going to get employment numbers. We want those employment numbers to be worse. We want more unemployment. I mean, that sounds horrible to say, but for the mortgage world, we want that. And we want wage inflation to slow. So as you know, guys, this last 3 years, inflation on wages is one of the main culprits, and that's the most dangerous of all. So when people demand $25 an hour to flip a burger, they're not going to go to work. That's wage inflation. And we all see it now. Like a Happy Meal for kids or like a Big Mac meal is like $13 now. It's and that's a direct correlation to wage inflation. They have to raise prices for everything moving forward. So that's the most dangerous. We hope that inflation will come in lower as we move forward. But those are the two major things that we're looking at and why rates will go up and why they'll come back down. So those are the things we want to be watching. So what I want to talk about right now is, what do we say to our buyers? This is the best line that I can think of that I've seen out there that's going to help us get buyers into homes right now. And this is from a realtor standpoint, if I could get you a mortgage rate in the 5s, would you buy a home now? Just ask that simple question. If their answer is, well, yeah, I think so, but we're going to wait until that happens. Well, if they wait until that happens, what's going to happen? Everyone's going to jump off the fence at the same time, right? So what are some strategies that we can build to help get those rates into the 5s now? But really get our buyers to think differently and not think about what's happening in the news and the media, but listen to us, right? What does it look like? A lot of times we can say that, but what does it look like on paper? So that's what I want to go over in detail. How do we present this model to them? What it looks like now with current rates, what it would look like if we ask the sellers to permanently buy down a rate or do the seller buy down. And then also, okay, we all know rates are going to come down. Let's model what the refinance is going to look for them 12 to 16 months down the road. So let's present that to them now so we have a plan to let them know this is not going to be forever with this rate. And if there's no room in the deal to have the sellers buy the rate down, what will it look like with that refinance? So I put together a report, and I'm going to open this real fast and see if I can get this to open while we're here. Accept. So here's a report that I put together, and these reports are what I present to all of my customers when we're looking at different mortgage options. So on this over here on the left-hand side, market price and rate, this is modeling current interest rates. Now, this was based on this weekend when I did it. Today we opened up a little worse, but 7 3/8. What does the payment look like? And then what does it look like if we ask the seller to do a seller buy down and we got the rate down to 5.75? That's a $642 savings a month. And then what does it look like if we do a 3-2-1 temporary buy down? And remember, this is a temporary rate buy down. It's not permanent, but we can get that all the way down to 4.375. And then future refinance. If we believe what Fannie Mae, Case-Shiller, all these different data heads are predicting for where rates will be in a year or two from now, they're all predicting low 5s to mid 5s. So I'm being optimistic here, throwing in 5.25. What would that look like? So compared to right now, if we just compared a normal purchase to a refinance in a year or two, they're going to probably save upwards of $800 by refinancing in the near future. Now, we all know rates are going to come down. We just don't know when. We thought they'd come down a little bit sooner than they have, but inflation has been stubborn, and we need to really have inflation come under control. So instead of 6 months, I'm saying a year to year and a half, we can refinance, save $830. But in the meantime, why can't we just get the sellers to pay for these? Now, we all have seen the markets this last 6 months, and there's a lot of competition still. So is this realistic right now? I think with the higher rates, it's going to slow down. We're going to get what we had at the beginning of this year, where it kind of slowed down and it was kind of crickets for a while. And then we saw a lot more of these seller buy downs happening, and we saw a little dip in the values. That may happen again with rates being where they are. It's hard to say, it's hard to predict, but with our inventory so low, it's counteracting what we can do, right? Because if we have 7 or 8 people trying for the same home, there's not going to be any room in there to ask the sellers for anything. So really, when we're looking at homes that are being listed, we're looking at homes that have been on the market for a little while, and may have the ability for us to ask the sellers. And this is based on a $700,000 purchase. So we're talking around 3% we're asking the sellers to give towards closing costs, which isn't out of the ordinary. But it would really tremendously help our buyers, because a rate of 5.75 right now may turn them into buyers instead of sitting on the fence. And again, if they buy now, they'll have the appreciation, hopefully, of maybe 2 to 3% over the next 6 months, 6 to 12 months. So far, year over year, guys, we are at 8% appreciation. Nobody thought that would happen. Everyone thought the market was going to crash, but we don't have inventory. So there's a lot of buyers. The millennials are a huge buying pool right now, the biggest that we've seen in a very, very long time. And they need homes, and there aren't any. So they're fighting for them, and that's what's causing that appreciation, despite the crazy rates that we're in. So these reports are very informative. If we can look at like a payment breakdown, I go over all of this with my customers line by line. We go over closing costs, points. If there's no points in here, the sellers are paying for everything. But when we're looking at these reports, it really is to illustrate that this is only temporary. We want to get the psyche going in our buyers, and illustrating what the future refinance would look like would be a tremendous help to let them know that this is only short term. Hopefully, Lord willing, the feds will win. There is a statement that we've all heard, and if you haven't heard it, it's what the feds say a lot, so you have to watch and be a nerd like me and watch what the feds say. But don't fight the Fed. Never fight the Fed is a term that a lot of people in the finance world use, because they will always win. They'll break things in order to win. So we don't want that to happen. That we don't want them to break it too hard. We want them to do a soft landing, so to speak. But don't fight the Fed, because they will get their way. They're trying to get inflation down to the 2% range. Usually mortgage rates are between 2 and 3% above what the inflation rate is. So if inflation's at 6 right now, which it is, guess what? Mortgage rates are 8. That's kind of how the correlation works. So as inflation drops, we're going to see mortgage rates drop. It's just a matter of time. But how do we get them into homes now? Some people are forced into buying right now. How do we help them in that circumstance? These are ways to do it. I know all of you have heard this, but I don't know if you've seen it illustrated like this before, where we can see it side by side, what the benefits are, and then what the payment, and then what the refinance down the way, what that will look like as well for future savings. So it's going to be tough out there, guys. I mean, it really is hard to sell things when they're expensive. I have a friend that works for Ford, and trucks are like $125,000, and interest rates are in the 6s. They're having a tough time on that too. I mean, it's hard to sell stuff when rates are high. It's just the way it is. But some people need it. We need to coach them through their options. And see, we have even if they get the inflation rate to 2%, the pass rate are already baked in, not going back. Yeah, I mean, it's going to be interesting to see when we do hit 2%, how long that'll be on the inflation numbers. So thanks, John, for that chat message. It's going to be really interesting to see how long it's going to take to get there. But here's the payment differences in those options. Market price, if we did a permanent buy down, that's over $600 savings. The 3-2-1 buy down is $1,100 savings a month. So really is a benefit. And here it is. I just pulled it into here so it's easier to see what the monthly savings is here at the bottom. Compared to market rate today and a year from now in refinances, or 2, however long it takes, they're going to be saving significantly in the future. So if they can afford it now, great. They will be able to have a lot more comfortable payment in the future. But if they're renting, guys, rents never do this. Rents never go down like this. You can't refinance when you rent, right? It always goes up. But in this case, they will be able to refinance and get that lower payment in the future. So if they're deciding on whether they want to rent versus buy, we do have some really nice illustrations for that as well that I can put together for you. on a different topic, but we really need to kind of focus on what the future is going to look like and what we can do to help them buy it down right now. So if you guys haven't seen some of my videos, this is my YouTube channel. You can click on that. I've got playlists of all loan programs, mortgage tips. I've got all kinds of stuff in there. But I want to open it up to just a discussion now and kind of see what you guys are thinking out there. I mean, you're out there in the field. What are your buyers saying right now, and sellers, what are they saying right now? And feel free to chime in. Be happy to hear what you guys have to say as well. Don't be shy. I learned a lot from you guys as well. Is it that depressing? Nobody wants to talk. It is tough, man. Rates in the 8s. A lot of condos right now are in the 8s. It's tough. It is very tough. But all we can do is stick together and really educate our buyers on what those options are. And cash buyers are king right now. I mean, almost 50% of buyers right now are cash in our market, and they will have the upper hand. So we need to try to get our buyers in there and just help them as much as we can. Are you guys hearing anything from your buyers? Are they mainly on the fence? Are they waiting?
Sean, John has another question in the chat.
Okay, John. So ask the seller concessions on 3% of the contract, which you can turn into a seller buy down. Yes, that's exactly right. So if you're going to make, if the listing price is $750 and you want your customer to have the 5.75 rate, you would ask for roughly 3%. We'll calculate that because it does change depending on what the markets are doing, but it's roughly around 3%. We'll use that to buy their rate all the way down. So they'll, instead of making an offer at 725, you're making an offer full price, but with that 3% down towards paying the buying the rate down. And I can illustrate that a lot of different ways when we're working with the buyers up front. I'll need you guys to really help me if there's properties that are available. I mean, if you're looking at a home that's one day on the market, you're not going to get this. I mean, we all know that we have to wait till the sellers are willing to give. And that's when the house has been on the market with no offers for 3 to 4 weeks or so. When they start to panic, right? They want to do a price reduction. Instead of doing that, let's get in at that point and then offer them full price with a seller buy down. So a seller would rather buy down than lower the purchase price. This helps buyers understand this. Yes, they would. Sellers want. Great point. Sellers want to sell their home at a higher. Realtors want a seller sell it at a higher purchase price because we don't want to see values go down. So I think overall, everyone would rather sell it for the higher purchase price than lower the purchase price. I think one of the reasons we didn't see too much of a drop in values is we saw a lot of people just lowering or giving concessions instead of lowering purchase prices. I think that was part of the market for the last year, but I think a seller would be more apt to want to work with the buyer to get them in at a lower rate than do a seller to then lower their purchase price. Absolutely. Absolutely. It's tough out there, guys. It's tough. Now, a little trick that we have a program called the Powerhouse 100. If you're dealing with somebody that is a first-time home buyer that's looking at condos, we have a program called the Powerhouse 100 that does not have any rate adjustment for condos, and that's a quarter in rate. So like if you have a mediocre credit score, like 720, I'm saying that's mediocre, but it's on the better side. But if you have 720 and you're looking at a condo and a rate with no points right now, you're in the 8s. But in this Powerhouse program, they're at 7. So we have some tools to help buyers get lower rates just by the programs that we have. But we're getting as creative as we possibly can to limit the pain on these payments because it's tough. I mean, when the average rate for somebody that has a 780 credit score putting 30% down is 7.5, 7 3/8, that's tough to swallow. But when those first-time home buyers, that have lower credit scores and they're doing conventional, that's even tougher. So we have to figure out ways and continually find ways of working together as teams to help our customers get the lowest rates possible. I know this is, you guys have heard this seller buy down here. It's like beating a dead drum, but I just want to show you how we can illustrate it to make it really real instead of just talking about it, like putting the numbers on paper and going side by side with them to really help them understand. I think will be a tremendous help. Hopefully we'll see a rebound here. If you look at I'm going to share my screen one more time. If you look at the markets, the mortgage-backed securities over the longer period of time, let's see if we can do this right now. This is just a short term. If we look long term back to last October, this is when rates did actually hit almost 8 for the best buyer possible. This was the worst place that we were at. Currently, we're right here. We're actually green for the day. We're gaining ground, guys. We were down 39 basis points, so we saw a little bit of a rebound here, but we saw we went all the way down here October of last year. I don't know if you remember that time, but it became crickets through the holidays. But then look, we saw a massive rebound. The mortgage-backed securities took off, and then they came back down, and the inflation numbers are just keep dragging on us. So hopefully we'll see a rebound. If you can see this flag pattern, up, down, up, down, up, down. We're on the down point. I'm hoping we can get a rebound here. So keep your fingers crossed that the data and everything that we're going to get over the next couple of weeks will push us that way and help us to be in a better position. But if you think rates are the same all the time, just look at this chart. It's been so volatile. And from a lender's perspective, it's been really challenging because we'll quote somebody a rate one day, and then 2 days later, they'll be, okay, I shopped around, your rate was the best. And my rate was only better because 2 days ago, rates were better for everyone. Or the opposite could be true. I'll quote a rate, and then 2 days later, rates get better, and then they'll go somewhere else, and the rates are much better because the markets got better. So they think they're getting a better lender. It's just the markets are volatile. Every day, the markets have changed. Maybe 1 and 2 times a day, the rates have changed. So it's very difficult on buyers to even shop when it's so volatile like this. Any other questions? What are you guys seeing in the markets? Am I the only one that's trying to be positive here and optimistic? We have to be, though. We have to be, that's for sure. But let's hope that we continue to see better movement in the bond market. We did rebound a little bit today, so that's good. Maybe we found a floor. I'm hoping, but let's just keep our fingers crossed. But with that being said, I'm here for you guys. I know it's tough out there, and let's just bear down and get after it and do the best we can with what we have and just make sure our buyers are educated. Any questions for me today?
Hey, Sean, this is John. Can you call me afterward?
Absolutely, John.
Thank you, sir.
You got it, John.
Thank you, Sean. That's
My
very helpful.
pleasure. My pleasure. I hope this helps you guys. Anything I can do to make it easier or to give you guys some ammunition with your buyers to discuss options, that's what I'm here for. You're very welcome, Nick. You're very welcome, John. All right, well, enjoy your week, guys. Say a little prayer for rates, and we'll stick in there and bear down and make sure that we're doing everything we can. We'll talk to you guys soon.